Hi all, this is Lokeshwari. So I am going to take cost and management accounting 2. So first we'll move on to the syllabus. So syllabus for this subject is first unit we'll see about reconciliation of cost and financial accounts. Second unit is about machine hour rate and contract costing. Third unit is process costing. Fourth unit budgets and budgetary control, and fifth unit is marginal costing. So we'll move on to first unit. So reconciliation. Reconciliation refers to the rectifying the entries which are made. Reconciliation of cost and financial accounts is the process. Okay, so it is the process of rectifying the entries which are not made correct in both financial accounts and cost accounts. So for different purposes, and the reconciliation ensures that the figures in both accounts are same and accurate. So these are the breakdown of key concepts. So first one is purpose of cost accounting and financial accounting. So cost accounting, it majorly focuses on the production of goods and services and the cost involved in it. So it helps businesses understand how much is being spent on producing products and aids in budgeting and budget control. Next one is financial accounting, and financial accounting is concerned with the recording, summarizing, and all other concepts of recording the accounting entries which are made useful to the management, and it provides financial statements to the authorities which are intake, such as investors, regulators, and tax authorities. So the financial statements include balance sheet, income statement, and cash flow statement. So the need for reconciling financial accounts and cost accounts arises due to the discrepancy between cost accounts and financial accounts. So if the profit or loss were calculated using financial accounts, it would be adjusted using cost accounts. The profit or loss shown by one of the set of books may differ, that indicate when cost accounts and financial accounts are handled in two separate books of accounts. So there arises a question of reconciliation. As a result, it becomes most important to regularly supervise both the accounts. It is done to look through both sets of accounts, mathematical precision, and look for any errors that may have happened before. So what is the need for reconciliation? So several factors call for a reconciliation between the two books. So it assists in verifying the mathematical precision of both sets of accounts. It majorly assists both sets of accounts using this mathematical precision. It guarantees the accuracy of cost accounting to properly determine the cost of manufacturing. So cost accounting is mainly concerned with cost determining, and financial accounts is mainly concerned with the producing the information to the stakeholders, investors, tax authorities, etc. It guarantees managerial judgment. So by reconciling both the accounts, we can judge the managerial decisions. So it allows management to create rules for expenses, depreciation, and other expenses, etc. And it guarantees that no revenue or expense item has been left out of the books of accounts, and that overhead costs are not being under or over recovered. So under recovered and over recovered is something we usually done in accounts. So under recovering is somewhat we denote expenses underly. So for example, if an expense is incurred for 500, we have denoted it as 100, means that balance 400 is under recovered, and likewise over recovered is above the amount. So items accounted for differently in cost and financial accounts. So first one is overheads. So overheads is nothing but the expenses which we incur in the business. So overheads is both for cost and financial accounts, and the profits on two sets of books of accounts will differ if such under recovery or over recovery of overheads is carried off to the cost, profit, and loss account. Second one is stock valuation. So stock valuation is valued at financial accounts at lower cost or market value, whichever is less. And in cost accounts, it is valued at a technique that is appropriate to the unit, such as FIFO method, LIFO method. By conducting these methods, they will arrive at a suggestion. As a result, stock value may change, which will indicate the profit discrepancy between the both set of books. Why? Because in financial accounts, they usually follow the cost value or market value, whichever is lower, and in cost accounts these methods are followed. FIFO method, LIFO method, and other such methods are followed to arrive at a cost of production. So last one is depreciation. So depreciation, as we know, the value, the decreased value in assets. The profits will change if a different methodology is used to calculate depreciation in cost accounts compared to financial accounts. So depreciation is mostly calculated in financial accounts alone. In cost accounts, depreciation is not calculated. So what is the procedure for preparing this reconciliation statement? First step is start by determining any one of the profit or loss figures. In question itself, they have given the profit or loss based on cost accounts or financial accounts. So we have to take either one of them. Step 2. The numerous discrepancies between the profits reported by two sets of books of accounts in a certain instance are determined. So what are the items they are giving? We have to consolidate whether it comes under financial accounts or it comes under cost accounts. Step 3. Increase the basic profit number by the items of difference that have the impact of raising earnings in another set of books. So we have to indicate whether it increases the profit or decreases the profit, and we have to determine add or less. Step 4. Subtract the items of disagreement that have the impact of reducing earnings in other sets of books from the basic profit calculation. So we have to add the items which have an impact in that, and we have to list the items which give us the impact. So this is the format for preparing reconciliation statement. So some items like expenses or losses recorded only in financial accounts but not considered in cost accounts. We have to take whether financial account profit is based on financial accounting as the basis or cost accounting as the basis. So we have to first determine that. Why? Because in most items, financial accounting, if we take base as financial accounting, we have to add some items, and if we take cost accounting as a base, we have to add some items. So it differs. Okay. So if financial profit is taken as a base, we have to add that item. What item? Financial expenses or losses recorded only in financial accounts but not recorded in cost accounts. We have to add that item. If cost accounting is taken as a base, we have to list that item. And under absorption of overheads in cost accounting. Under absorption means we have taken that figure as a less amount. So under absorption of overheads in cost accounting, if financial accounting is taken as a base, we have to add that item, and cost accounting is taken as a base, we have to list that item. So likewise, all expenses are given here. So what is the importance of reconciling? So first one, accuracy. It ensures the accuracy between both cost accounts and financial accounts. So this accuracy is vital for compliance with accounting procedures and process. Next one is profit consistency. So the profits shown in financial accounts and cost accounts are same. We have to be confident. Why? Because the profit in cost accounts and financial accounts are both and same. Third one is error identification. It helps to identify the errors easily. Why? Because if we randomly check through the cost accounts book and financial accounts book, we have whether it's a simple data entry mistake, we can rectify it. Fraud prevention. So reconciliation can help prevent fraudulent activities by identifying common practices such as duplicate checks, altered invoices, etc. Decision making. So it helps the management by providing the financial data. By reconciliation aids businesses in making informed decisions. Internal control. Reconciliation helps management to acquaint itself with the reasons for variation in profits and paving the way for more effective internal control. So with that, unit 1 gets over. We'll move on to unit 2. Mission hour rate. So in manufacturing industries or manufacturing companies, we use lot of machineries, plants, etc. So in that mission, we have to calculate the hour rate. What is the hourly rate in which the labors involved in that or electricity or power all comes under mission hour rate. So mission hour rate is one of the methods of absorption of factory overheads into production. So in industries like chemical industries, steel and other heavy industries where the work is done mostly by machines, it is desirable to adopt the machine hour rate method for the absorption of factory overheads. So why? Because factory overheads largely consist of expenses likely providing to machines. Okay. So relating to the maintenance and operations of machines. Under the machine hour rate method, first a separate machine hour rate is established for each machine or a group of similar machines. So particular for n number of machines, we have to denote the machine hour rate. Then at the established machine hour rate of factory overheads are charged to production depending upon the number of hours for which a machine or machines are used for the particular produce of a product. It refers to the overheads incurred for running machine for an hour. So how long a machine is running. So in that we have to take the hourly rate. This is the most scientific method of overhead absorption when compared to all other methods. So in other words, machine hour rate refers to the amount of factory overheads incurred for running a machine. In short, machine hour rate means the factory expenses incurred in running a machine for an hour. So machine hour rate is expressed as a formula here. Machine hour rate is equal to overheads to be absorbed divided by machine hours. So this method is more suited to companies where machines are predominantly used in major factories. Computation of machine hour rate. So machine hour rate can be calculated for a specific machine or a group of machines. So the particulars required for computing machine hour rate are expenses chargeable to each machine. As I already told you, what are the expenses which are chargeable to each machine, like depreciation, power, labor, etc. The total hours worked by each machine or group of machines. How long the machine is working? For 24 hours, how long the machine is working? The overhead expenses of machines are classified under two heads, which is fixed charges and standing charges, which remain constant irrespective of the use of machines, and machine expenses vary with use of the machine. Okay, so fixed charges means it will remain constant irrespective of the use of machines, and the standing charges means it will vary. The machine expenses are estimated separately and then divided by the number of working hours to give hourly rate of the item. The total of standing charges per hour and machine expenses per hour is the ordinary machine hour rate. So this is the format for calculating machine hour rate. So as I already told you, standing or fixed expenses will come under first. So total standing charges, and under that we have to calculate the machine hour rate. So first is standing or fixed expenses, rent, rates, taxes according to the areas used by each machines. Whether we have to calculate for one machine or a group of machines. Lighting and heating, and it comes under power. Supervision expenses, it comes under staff expenses. Labor welfare expenses, insurance, manager salary, foreman salary, canteen expenses, consumable stores and other expenses. It all comes under standing or fixed expenses. Next is mission expenses or variable expenses. So under mission expenses, we have first item, which is depreciation. So depreciation, for calculating depreciation, the formula is cost of machine minus scrap value divided by total working hours of the machine. Repairs and maintenance. For repairs and maintenance, amount will be given. For a total amount will be given, we have to calculate for 1 hour. So repairs and maintenance divided by working hours for given amount of repairs and maintenance. Third one is power. So power we have to calculate by units consumed per hour into units rate. Last one is steam and water. So in most of the sums, steam and water will not be given. So these are the items which we look into. So what is the advantage of machine hour rate? By calculating machine hour rate, what are the advantages we are getting? So this method takes into account time factor and hence gives accurate results. It provides useful data for estimating the cost of a job, setting standards, and for fixing selling prices. So it helps to compare relative efficiencies and the cost of operating different machines. This is an ideal method of absorption where production is carried out on machines. So as I told you, it is a scientific method and practical and accurate method of absorption of factory overheads in industrial undertakings where the work is done predominantly by machines. Disadvantages of machine hour rate. It involves additional work in accessing the working hours of machines, and thus it is a costly process and costly method. It gives inaccurate results, and if manual labor is equally important. This method is not suitable where most of the production work is done by manual work. So it involves more of manual work, so it is regarded as a disadvantage of calculating machine hour rate. Next one is contract costing. So a contract is the cost unit. Contract costing is one of the variations of specific order costing, and as per the CMIA terminology, contract costing is a form of specific order costing in which costs are attributed to individual contracts. Due to high unit value, each contract is negotiated by the contractor and the contractee in detail, and usually a formal contract is signed which specifies all the terms and conditions are agreed in detail. Examples of contract costing are construction of buildings, ships, plants, dams, etc. So this method is very widely used in construction work alone. It is similar to job costing, but they differ basically in the aspects of size and duration. Features of contract costing. So first one is cost unit. So each contract is treated as a separate cost unit, and these costs relate to material, labor, overheads and other subcontracting are all traced to the contract itself. Second one, long duration project. As we already discussed, construction of dams, buildings, etc. incurs a long time, and contracts are typically long term, spanning multiple accounting periods, sometimes lasting several years. Third one is site specific cost. So most contracts are performed on the contractee's site, meaning costs like transportation site, equipment and labor are directly to the specific condition and location. Payment in installments. So contracts are usually paid in installments alone as the work itself extends to a long period. Profit calculation. Profits are calculated progressively, allowing the contractor to report partial profits annually instead of waiting until the work gets done. So next we'll move on to Unit 3, process costing. So process means the step-by-step process which manufacturing companies involve. So in most of the manufacturing companies, many processes will be done on the same basis. Okay, so process 1, process 2, process 3, after that alone we get a finished product. So that is what is called as process costing. So process costing refers to a costing method that is used for assigning production cost to mass produced goods. For example, large manufacturing companies that mass produce inventory might use process costing to calculate the total amount of direct and indirect cost associated with product that are completed and left in process at the end of the given time period. Different departments such as design team, floor team, assembly department, even shipping and receiving team can have separate processing costs associated with unit production. Some industries where process costing methods might be applied are the food industry, fuel and oil industries and chemical industries. Features of process costing. So output of one process becomes the input of another process. Cost per unit is ascertained by dividing total departmental cost by total departmental production cost inclusive of work in progress. Costs are charged to departmental work in progress account itself. The production is continuous and the final output is the result of a series of operations. Cost is accumulated at the end of each process or after a certain interval. Since the production process is continuous, work in progress will be partly finished stage. So production is reported by process or department. Standard costing system can be applied for effective cost control. Production is carried out for stock and not for any specific order. Process losses. So in process accounting we incur both profit and loss. So what is this process loss? So in most of the industries which employ process costing method, process loss is arrived in the nature of wastage, scrap value, normal loss, abnormal loss, spoilage, etc. and occur at different stages of the manufacturing cycle. There is certain amount of loss that occurs at various stages of production which may be attributable to evaporation, chemical reaction, inefficiency, etc. It can be classified into, as I already told you, process loss can be classified into two. One is normal loss and another one is abnormal loss. Such loss is also called as process loss or loss wastages. It results in wastage of units during the manufacturing process cycle. So normal loss. So normal loss is unavoidable and uncontrollable. It cannot be controlled and it cannot be avoided. It is to be expected in normal conditions of the process. A separate normal process account is opened in a ledger. For this account itself, a separate ledger is opened. As a part of cost control, management estimates such loss in advance on the basis of past experience. The normal loss should be absorbed by the goods to be produced. The quantity of normal loss is computed and credited to the process account in the units column. The amount which is desired as normal loss will be transferred to process account in the credit side. If the material scrap has some realizable value, that is also credited to the process account in the amount column. It is debited with the normal loss of different processes. Cash realized from the normal scrap and the scrap value of abnormal gain units are credited to the account. This is necessary because abnormal gain results in reduction of the normal scrap receipts. The account shows no balance. Next one is abnormal loss or abnormal wastage. So when process loss is in excess of predetermined loss, such additional loss is also called as abnormal loss or abnormal wastages. So such loss may be caused by abnormal reasons such as substandard material, faulty tools and equipments, plant breakdown, etc. Abnormal loss should not be allowed to affect the normal cost of production. Therefore, it is valued just like good units produced. The abnormal loss is controllable and not repetitive in nature. So, normal loss is uncontrollable and avoidable. Abnormal loss is controllable and repetitive in nature. Not repetitive in nature. The firm should take all the necessary steps to avoid whatever the steps we can take, we can control to avoid this abnormal loss. The units of abnormal loss and their value are both credited to the process account concerned in the respective columns. A separate account is opened in the ledger account for abnormal loss. So for normal loss also a separate ledger account is opened. The quantities and values of abnormal loss from different processes are debited to this account. Next one is abnormal gain. So when process loss is less than the predetermined normal loss, the additional output realized therefrom is known as abnormal gain or abnormal effectives. Abnormal gain can occur because of superior quality material, better workmanship, improved methods, tools, equipments, etc. The units of abnormal gain and their value are both debited to the process account concerned in the respective columns. As a part of cost control process, the causes for abnormal effective should also be investigated. The account is credited with units and value of abnormal gains in different processes. It is debited with the loss and scrap value of normal loss, which did not materialize because of the occurrence of abnormal gain. So next we move on to Unit 4, which is budget. So a budget is the predetermined statement which we will prepare. So in companies also they will prepare budgets. So it is the monetary and or quantitative expression of business plans and policies to be pursued in future period of time. Budgeting is preparing budgets and other procedures for planning, coordination and control of business enterprise. So it is a detailed plan of the policy to be conducted in future during the period for which the budget is prepared. Budget is prepared for a particular period and it is prepared in advance itself. The function of the budget is to attain a specific objective. A budget is a financial statement, but it can be a statement of quantities also with or without monetary values. So according to ICMA, defines budget as a financial and quantitative statement prepared prior to a defined period of time of the policy to be pursued during that period for the purpose of attaining a given objective. Meaning of budgeting. Budgeting refers to the process of preparing the budgets. It involves a detailed study of business enterprise, clearly grasping the management objectives, and the available resources of the enterprise and capacity of the enterprise. It is a process of making the budget plans. Preparation of budgets or budgeting is a planning function, and the implementation is a cost control method. Budgetary control starts with budgetary and ends with control. So, meaning of budgetary control. Budgetary control is the process of preparation of budgets for various activities and comparing budgeted figures for arriving at derivations, if any, which are to be eliminated in future. So, budgetary control is a continuous process which helps in planning and coordination. So, it also provides a method of control. Corrective action is initiated to set right the unfavorable deviations. Actual performance is compared with budgets to reveal deviations for the purpose of cost control. So, in budgets, we will see 5 types of budgets. First one is production budget, sales budget, fixed budget, flexible budget, and last one is cash budget. First, we will see production budget. So, this budget is based on sales budget, unless production itself is the key factor. It shows the budgeted quantity of output to be produced during a specific period. It has 2 parts, one showing the output for the period and the other showing production cost. So, second one is sales budget. In the budgeting process, sales is the starting point, as sales is the key factor in many cases. WW Big writes, this is probably most important budget, as it usually the most difficult of forecast to attain. The problem with preparation of sales budget lies in correct forecasting and estimation of sales quantity, and this will be more complicated if the sales budget is to be done for a specific period and for a new product. The sales budget shows quantity of finished products to be sold and price at which they are sold. Third one is fixed budget. So, it is a budget designed to remain constant irrespective of the level of activity attained. So, it does not change irrespective of the level of activity attained. A fixed budget has been defined by ICMA England, as a budget which is designed to remain unchanged irrespective of the level of activity which is attained. Even when the conditions remain same, the actual output is generally different from the desired output. The internal and external factors force the level of activity to change, but it does not change irrespective of the activity. The fixed budgets are ineffective as a tool of cost control. Fourth one is flexible budget. Flexible budget is designed to change according to the level of activity. Flexible budget has been defined by ICMA UK as a budget which has been recognizing the difference between fixed, semi-fixed and variable cost, is designed to change in relation to the level of activity. Cost of various levels can be easily obtained. Price fixation and estimation of profit at different levels of activity is made easy. Last one is cash budget. So, it is an important budget in any business. So, it estimates the amount of cash receipts and payments which has to be received and which has to be paid during the time period. The cash budget is based on a forecast of cash or estimates of cash, showing what funds we have would be available at what times and whether the funds could be meet requirements. The objective of cash budget is to provide for all cash requirements in time and avoid accumulation of excess cash. So, this is a sum which is under production budget. So, the question is, from the following details in units, prepare production budget for the year 2006, assuming sales as limiting factor. So, for product A and product B, three stocks are there, X, Y and Z, and under product group B, we have product P and Q. The opening stock is given and the budgeted sales are given. Stock of Y and X is to be maintained at 10% above the existing level to sustain the budgeted sales. Stock level of X may be reduced by 20%. Stock of Q is proposed to be raised by 30,000 units for export market, not considered in sales budget given above. So, by this information, we have to prepare production budget for the year 31/3/2006. So, first, production budget has a formula. What does that mean? Sales budget plus desired closing stock minus opening stock. Okay. So, what is the sales given here? For X it is 2 lakh, for Y it is 2,50,000 and for Z it is 5 lakhs. Under product B we have P 1 lakh and Q 50,000. So we have to add the desired closing stock. So it is given here. So stock of Y and X is to be maintained at 10%. So stock of Y and X is maintained at 10%. Stock of Y and X is to be maintained at 10% above the existing level to sustain the budgeted sales. So stock of Y is 60,000 and stock of Z is 1 lakh. Okay. So under this we have to calculate the amount which is here. So 60,000 for Y it is 60,000. 60,000 10% means we have 6,000. So 60,000 plus 6,000 gives 66. And for Z it is 1 lakh. In 1 lakh for 10% we will get 10,000. 1 lakh plus 10,000 is 1 lakh 10,000. So here it is given 66,000 and 1 lakh 10,000. Okay. And stock level of X may be reduced by 20%. We have to reduce the stock level by 20%. For stock level X is 50,000 units. So 50,000 into 20 will give you 10,000. So it is reduced. So we have to minus that item. So 50,000 minus 10,000 will give you 40,000. Okay. So likewise we have to calculate for each one product. So we will arrive at a solution. By adding closing stock and sales budget we will get the sum. And after that we have to reduce the opening stock. Opening stock is given here itself. So 50,000, 60, 1 lakh, 10,000 and 20,000 we have to put that. And under this we will get planned production units of 1 lakh 90,000, 2 lakh 56,000, 5 lakh 10, 1 lakh and 80,000 for each product. So next one is preparing flexible budget. So prepare a flexible budget for the production of 80% activity and 100% activity. So production at 50% is given. We have to prepare 80% and 100%. By preparing this, by keeping this as a base, we have to prepare for 80% and 100%. Raw materials given, labor, direct expenses, factory and administrative expenses are given. We have to prepare a flexible budget. So flexible budget at a capacity of 50%, 80% and 100%. For 50 alone, question is given. We have to calculate for 80 and 100. So raw material is 4 lakh. So raw material is 80 per unit. So production at 50% capacity is 5,000 units. So we have to multiply 5,000 into 80 will give you 4 lakhs. And likewise we have to put all the items. Total cost will arrive at a sum. And for 80% we have to calculate under. We have to keep the we have to change the units. Okay. So for 50%, 5,000 units is producing. For 80%, what is the amount of units we are producing? And likewise for the 100% also we have to calculate. For 50%, 5,000 units are producing. For 100%, what is the amount of units we have produced? So by calculating that, we will arrive at a solution. So last unit 5, marginal costing. So marginal costing is a costing technique that helps business determine the cost of producing one additional unit of a product or service. So it is also known as variable costing because it only considers the variable cost ascertained associated with producing an additional unit of a product or service such as direct labor, materials, etc. Under marginal costing, fixed costs such as rent, salaries are considered as period costs that are not directly related to the production of a specific unit. Instead, fixed costs are expenses in the period they are incurred. It can be useful for decision making as it allows every business to determine the profitability of producing additional unit of a product. So features of marginal costing. Variable costs are not charged to production, fixed costs are not charged here. As this marginal costing is the amount of additional unit which we produce. Cost volume profit analysis is one of the integral parts in marginal costing. Profit is calculated by deducting marginal cost and fixed cost from sales. Selling price is based on marginal cost plus the contribution. Meaning of absorption costing. So absorption costing, also referred to as full costing or full costing method, is an accounting method that you can use to capture all the manufacturing costs associated with the production of one unit of goods. So absorption costing allocates fixed overhead cost to a product whether or not it was sold in the period. This type of costing method means that one more cost is included in the costing itself. So marginal costing versus absorption costing. So marginal costing and absorption costing difference here are given. Nature of overheads, variable cost and fixed cost. In marginal costing, we will allocate both variable cost and fixed cost. But in absorption costing, distribution, production, selling and administration costs are incurred. What does it determine? It determines the cost of the next unit, and in absorption costing, it determines the cost of each unit. So these are the important formulas under marginal costing. Contribution, for calculating contribution, there are two different formulas. One is sales minus variable cost and the other one is contribution minus fixed cost or fixed cost plus profit. So marginal cost ratio is sales minus variable cost is equal to fixed cost plus profit. This is what is marginal cost equation. So for calculating contribution, sales into PV ratio also used. For PV ratio, contribution divided by sales. So these are the important formulas which we will discuss later. So this is one sum under marginal costing. The Acme company produces and sells one product. The revenue and cost structure of the product is given below. Selling price per unit is 10 rupees, variable cost per unit is 6 rupees, total fixed cost per year is 1 lakh rupees. Compute the break-even volume in units and rupees. So we have to calculate break-even volume both in units and in rupees. So contribution is equal to sales minus variable cost as we already discussed. For calculating break-even point, the formula in units is fixed expenses divided by contribution per unit. Okay. For fixed expenses, the question itself is given here. Fixed cost per year is 1 lakh. So we have to calculate only contribution per unit. So contribution per unit we have to find out. So contribution is equal to sales minus variable cost. So in question it is given as per unit itself. Okay. So sales minus variable cost will give you contribution. 10 minus 6 is equal to 4. So contribution per unit is 4. By dividing 1 lakh by 4, we will get 25,000 units BEP, break-even point. So then we have to calculate break-even point in amount. For amount, formula is fixed expenses divided by PV ratio. Same as above formula, but in denominator itself it changes. So for that we have to calculate PV ratio first. For calculating PV ratio, the formula is contribution divided by sales into 100. So contribution is 4 rupees, sales is 10 rupees, into 100 we will get 40%. By substituting this in this formula, we will get 2,50,000 rupees. Thank you.